All right, let's dive right into this explainer. Today, we're putting First Mid-Bank shares through what I like to call the ultimate valuation gauntlet. We're going to analyze this stock using the legendary frameworks of the absolute greatest investors of all time. We've got the raw data, we've built the models, and we're going to figure out if this regional bank is a hidden gem just waiting to be scooped up, or if it's a classic value trap.
Here's our roadmap for the gauntlet. We'll grab a quick baseline snapshot of a company, then pressure test the stock against the distinct philosophies of Buffett, Lynch, and Graham. After that, we'll run some modern DCF models, and finally bring it all together for a final verdict. Okay, Section 1, the snapshot. Let's get to know our contestant. First Mid-Bank Shares, trading under the ticker FMBH, is a community banking and financial holding company that handles commercial, retail, and agricultural banking across the U.S. Right now, the stock is trading at $48.46. This is a super relevant entry point for any investor because it's sitting just a hair below its recent all-time high of $49.05. A lot of that momentum is being driven by strong market sentiment and a major leadership transition, with Matthew K. Smith stepping in to take over as CEO.
And honestly, their fundamental momentum is pretty undeniable right now. FMBH recently delivered a massive Q2 earnings beat, posting $1.14 per share, completely crushing the estimated 95 cents. They're also operating with a nearly 20% net margin. Think about that. They're incredibly efficient at turning top-line revenue into actual bottom-line profit. Add in a solid return on equity of 10.44% and a steady 25-cent quarterly dividend, and the foundation looks rock solid. But let's see how it holds up under real scrutiny.
Moving to Section 2, the Warren Buffett lens. Let's find out if FMBH can survive our very first chamber. Keep in mind, the Oracle of Omaha doesn't just buy stocks, he buys businesses. Buffett's framework comes down to a few absolute non-negotiables. He demands a definitive economic moat, highly consistent owner earnings, a strong return on equity, and completely manageable debt. He also wants honest leadership he can trust, and above all else, he needs a wide margin of safety on the intrinsic value.
So how does FMBH stack up against those rigorous standards? Actually, remarkably well. They deliver a very respectable 10.44% return on equity. Plus, the source data explicitly points out that FMBH has a flawless balance sheet, which effortlessly clears Buffett's hurdle for manageable debt. As for leadership, that fresh management stepping in offers a great opportunity for a renewed, long-term strategic vision.
But here is the absolute kicker for Buffett, a 46.97% intrinsic value discount. That is a massive margin of safety. It's the ultimate buffer against things going wrong. Now, we do have to note a recent 2.15% annual revenue decline, which is a slight ding against perfect earnings consistency. But with the discount that deep, Buffett might just see this as a wonderful company selling at a very fair price.
Let's shift gears and move to Section 3, the Peter Lynch lens. Lynch was famous for categorizing investing. He wanted to know exactly what kind of story he was buying. His whole framework hinges on categorizing the stock right out of the gate. Is it a fast grower, a slow grower, a cyclical, a turnaround, or a stalwart? Once he nails that down, he digs into the PEG ratio, so price to earnings relative to its growth rate, along with the balance sheet strength and institutional ownership. The goal? Making sure you aren't overpaying for that specific flavor of growth. Given its size, its stable footprint in the regional banking sector, and that reliable 25-cent quarterly dividend, we can safely categorize First Mid-Bank shares as a classic stalwart. This isn't some hyper-growth tech startup. It's an established financial institution built to provide steady returns and act as armor during economic dips. Now, the market's pricing of this stalwart tells a really fascinating story. At a 13.4x price-to-earnings ratio, FMBH is slightly more expensive than the broader U.S. banking industry average, which sits at 12.2x. But it's essentially sitting right in the middle of the pack. While it's not the absolute cheapest bank out there, it's a fantastic value compared to its direct competitors, who are trading at a much steeper 16.1x average.
Taking all of this into account, especially considering that top-line revenues have dipped slightly by that 2.15%, Lynch wouldn't view this as a screaming fast grower buy. Instead, he'd likely see it as a rock-solid hold. It's the kind of stock you accumulate on the dips to harvest those reliable dividends, trusting that flawless balance sheet to weather any macroeconomic storms.
Next up is Section 4, the Benjamin Graham lens. Time to strip away the market sentiment, the narratives, and the feelings, and look purely at defensive worth through cold, hard math.
Graham is the undisputed father of value investing, and of course, Buffett's mentor. He relies on this incredibly strict formula to determine a stock's true defensive worth, based entirely on its current earnings and its book value. He literally doesn't care about future promises. He only cares about what the company is verifiably worth on paper today. To run his formula, we have to extract and project our data. First, we take that massive Q2 EPS speed of $1.14 and annualize it, which gives us $4.56. Now, because the exact book value per share wasn't explicitly stated in our snapshot data, I'm making a calculated assumption to reverse engineer it. By dividing our annualized EPS of $4.56 by the 10.44% return on equity, we arrive at an estimated book value per share of exactly $43.67. Now, we just crunch the numbers. We multiply Graham's strict base multiplier of 22.5 by our earnings of 4.56 by our book value of 43.67. That gives us roughly $4,479. Then we just take the square root of that number and boom, Graham's formula spits out a deep value intrinsic price of $66.93 per share.
At its current trading price of $48.46, FMBH is sitting at roughly a 27% discount to Graham's notoriously strict valuation. For a defensive investor, that is a massive green flag. Finding a stock trading this far below its pure mathematical intrinsic value is exactly the kind of deep value setup Graham spent his life looking for. Moving right along to Section 5, DCF and Alternative Valuations. Let's step out of the past for a minute and look at modern, forward-looking models to see what the future cash streams are whispering to us.
First, let's evaluate comparable multiples. The data estimates a fair PE for FMBH to be right around 14.1x. That means, even though it's trading at 13.4x right now, there is still slight upside just based on market sentiment normalizing to its peers. That 14.1x multiple implies a fair price target right around $51 a share.
But the gap between the current price and the discounted cash flow valuation is just wild. When you forecast future free cash flows, apply a terminal value using perpetual growth, and discount it all back using the weighted average cost of capital, the DCF model generates a massive fair value of $91.39. It heavily suggests that if FMBH can consistently grow their future cash as projected, the stock is severely undervalued today.
Which brings us to Section 6, Final Synthesis and Verdict. We have officially run the gauntlet. Now let's tally up the final scorecard. The final breakdown reveals a really fascinating split decision. The absolute valuation models, Graham's strict historical math, and the future-facing DCF cash flow models are basically screaming that this stock is a buy, with fair values ranging anywhere from $67 to a staggering $91. But when we shift to relative market valuations like peer multiples and the analyst consensus target of $49.95, the market consensus is that the stock is currently fairly valued, signaling a steady hold.
So what's the bottom line? We have a company boasting a flawless balance sheet and a highly profitable near 20% net margin, but it's fighting against the slight top-line revenue dip of 2.15%, while currently trading near its all-time highs. For the pure value investor, the math points to a cautious buy. But the ultimate question you have to ask yourself after reviewing this explainer is this: do you trust the modest, cautious earnings multiple of the broader market, or do those massive future discounted cash flows tell the real story of what First Mid Bank shares is actually worth?